Have you ever paused to ponder why cryptocurrencies, like Bitcoin, come under fire for their lack of intrinsic value? The irony lies in the fact that traditional fiat currencies, such as the United States dollar or the euro, are not fundamentally different in this respect. Indeed, the design of fiat currencies intentionally omits intrinsic value. Fiat currencies get their value from the simple fact that governments declare them as legal tender. This means they stand as a valid form of payment to settle debts. The significance of fiat currencies is even more pronounced because governments will only accept their own fiat money for tax payments. Legal tender, a term that often goes hand in hand with currency, is a vital concept in the financial world. This term means that a particular type of money must be recognized as a legitimate form of payment for financial obligations. However, bear in mind that not all currencies are legal tender everywhere. Typically, a currency's status as legal tender only applies within its home jurisdiction. Some countries employ a strategy known as a currency peg to maintain fixed exchange rates. This strategy involves setting a specific value for one currency in relation to another, and then managing the supply to maintain that rate. Currency pegs thus emerge as a fascinating tool in the economic toolbox. A striking episode in financial history involves the legendary currency speculator George Soros, who managed to break the Bank of England. Soros, equipped with more resources than the central bank, persistently targeted their pegged exchange rate, marking a monumental moment in currency trading. Moving on to 1944, in Bretton Woods, representatives from 44 countries established an international gold standard agreement. The United States dollar was pegged to gold, while other currencies were pegged to the dollar. However, this system faced numerous challenges and eventually collapsed in 1971. Enter the practice of quantitative easing, or QE, a policy employed by central banks to stimulate the economy by ramping up the money supply. This involves central banks purchasing assets, predominantly bonds, from the private sector to inject money into the economy. However, two key concerns are associated with QE. The first is potential devaluation of the currency and inflation due to an increased money supply. The second concern is the risk that central banks assume when they hold riskier financial assets on their balance sheets. Understanding these historical events and monetary policies illuminates the complex dynamics of the global financial system and the nuances of central banking operations. So there we have it. Fiat currency, though devoid of intrinsic value, gains its significance through the laws of legal tender and its practicality in everyday transactions. By untangling these intricate aspects, we can begin to understand the inner mechanics of the global monetary system.